Welcome to May, everyone. I cannot believe that we are so far into the year, almost, well, halfway, getting there. But anyhow, hope everyone's doing well. And the other day I asked my wife if I should do a show about risk management, and she literally fell asleep standing up. All right. Joking aside, though, I know it's not the sexiest of topics, but I promise that if you develop the habit of rules-based trading and incorporate risk management, then you will spend more time writing the good trades and cutting the bad ones early. Early is a key when they're young and small. So, one of the great hedge fund traders of our time, Paul Tudor Jones, said, quote, "The secret to trading is to lose the least amount possible when you're wrong," unquote. So I want you to remember that. And you've probably heard the saying that a penny saved is a penny earned. And nothing saves more pennies than the practice of good risk management. So the definition of risk management, it is the process of identifying, assessing, and mitigating potential threats to your money, okay? Identify, assess, and mitigate. And it's not about avoiding risk. No one can avoid risk. It's about not getting wiped out when you're wrong, okay? Even the best investors, the most successful investors, are wrong 1/3 of the time. 1 out of 3 times they are wrong. It's knowing what to do when you're wrong. So there are two principles of risk management. There's risk capacity and risk tolerance. Risk capacity is just that, mathematically. It's how much you can stand to lose and still pay your bills. Capacity. Now, risk tolerance is a little more nuanced. It's your psychological ability to effectively manage panic. Okay? Fear and greed, as we know, drive everyone. Everyone has that fear and that greed. The whole market does. It's about accentuating, excuse me, accentuating the fear and quieting the greed. Let me say that again. Accentuate the fear and quiet the greed. Okay? Be smart and be nervous. Benjamin Graham, the mentor of Warren Buffett and the author of The Intelligent Investor, said, quote, "The essence of investment management is the management of risks, not the management of returns," unquote. So focus on the risk, talk about the risk, obsess over the risk. Spend your time doing more of that and the returns will just show up. I love talking about losses. I consciously avoid talking about my wins, and selling at a loss. When we sell at a loss and everyone has to do it, it's easy to walk away and to make excuses and to, downplay it. But instead, I like to frame it as this, okay? A loss to me is like paying for an education. Literally, I think about it as a tuition, a cost of tuition for an education. What did I learn and what did it cost me? Okay. What will I remember to do and not do next time? Because mistakes are allowable, they're inevitable, it's okay. But repeating mistakes, that is unforgivable. Losses are your tuition to better investing. Learn your mistakes, take your losses, but learn from them. Remember them. So the bad trades are going to happen. Bad trades will happen. So early and small losses are the best. Absolutely. Cutting early and cutting when they're small, that is the practice you want to develop. But the fact is, realistically, sometimes we get stuck with a stock. Okay. So before I ever buy, when something is at a loss, but it's still a small position because we've talked about the dollar cost averaging, but we get stuck with bad trades sometimes. So before I ever buy a stock, I ask that if everything goes wrong, if all the research, the fundamental technical analysis, everything that I do researching a stock, if the trade goes wrong, do I believe in this stock? Am I okay owning this company if the trade doesn't work? What a company does and how well they do it is essential. So before buying, please just always ask yourself, if everything goes south, am I okay owning this company? Do I still believe in it? So there's no substitute for fundamental analysis. You got to do the hard work. You got to know the essence of the balance sheet from memory, okay? Be able to just recite off those key metrics that we've talked about previously and we'll talk about again. Know the balance sheet from memory, study the biographies of the company leaders, listen to the quarterly earnings calls. I can't believe that people won't take the time, the 30 minutes, 45 minutes to listen to a call once every 3 months. So do that work. Use AI to search the company details, the history, their moat to competition. Read the analyst upgrades and downgrades. Those men and women do hard work and deep research on these companies. Ride off of their hard work and read what they're saying about the company and why they're upgrading or downgrading it, and do some simple technical analysis. It doesn't need to be complex. Know just some few basics like the RSI, the Relative Strength Index, the 14-day Relative Strength Index, the daily trade volumes. Are they thin? Are they, massive and inflated, above average? Know the 50 and the 200-day moving averages. I promise, if you just know those four metrics, you will be so keyed into an exogenous move in the stock. So I like simple. I love simple. I like to go deep into the research and then come back up to periscope depth. So just know what you own. Okay, just know what you own. Do your homework. Always focus on the risk first. Obsess over the losses and downplay the wins. Don't settle for first round thinking. Go a little bit deeper. Go a level or two deeper with questions and research. Warren Buffett, the most successful modern investor of our time, said, quote, "The average investor spends more time choosing a refrigerator than researching a stock," unquote. Okay? Just do a little bit more. People settle for average and simple. And so we're lucky. I think we are so lucky these days. We've got the internet, we've got AI. Insider information is so democratized compared to 50 years ago and 100 years ago. We're lucky to have all this information at our fingertips. So analyze your investment thesis after doing all that fundamental and technical research and looking at the leadership of the company. Analyze your thesis, then before you buy, test it. Reanalyze everything you've come up with and ask yourself again, take a second look at it. And well, you know what they say, measure twice, cut once. Okay. So do that hard work and put it to the test. So again, there's nothing sexy about risk management, but being overly cautious means making money the safe way. And I can't emphasize the security in that and the how great it feels to make the safe choices and not be far out on the risk curve. So learning and practicing risk management is, in my viewpoint, it's essential. Okay. History's most successful investors have all preached this discipline. This show only introduces this important topic and the habit. And if risk management makes sense to you, I hope you do further research on it and make it a quintessential cornerstone of your stock trading practices. As always, I appreciate you. I hope things are well, and we're almost into the summer season, so let's see what happens next. Cheers. Bye-bye.